Adjusting entries. Adjusting entries are important in accounting as they ensure that a company's records follow the matching principle. The matching principle dictates that expenses should be recorded in the period resources are used to generate revenues. There are 4 types of adjusting entries scenarios: deferred revenue, accrued revenue, deferred expense, and accrued expense. Deferred revenue, or unearned revenue, refers to when a company receives cash before providing a particular service. This initial payment is recorded by debiting a company's assets via the cash account and crediting a company's liabilities via the unearned revenue account. However, when the company provides the service at a later date, it has earned the previously unearned revenue. Therefore, an adjusting entry is required. This adjusting entry debits a company's liabilities via the unearned revenue account and credits a company's revenues, thus recording that the revenue has been earned. Accrued revenue refers to when a company earns revenue before it receives the cash. This initial event is recorded by debiting a company's assets via the accounts receivable account and crediting a company's revenues. However, when the cash is received at a later date, an adjusting entry is necessary. This entry debits a company's assets via the cash account and credits the accounts receivable account, adjusting it back to its initial value, thus recording that the cash has been received. Deferred expense refers to when a company pays for a resource before it uses or consumes it. For example, if a company pays for its rent in advance, this is recorded by debiting a company's assets via the prepaid rent account and also crediting a company's assets via the cash account. However, as the company uses the rent over time, an adjusting entry is necessary. This entry debits a company's expenses via the rent expense account and credits a company's assets via the prepaid rent account, thus recording that the rent expense has been incurred. Accrued expense refers to when a company incurs an expense and pays for it later. For example, if employees work for a company but aren't paid until a later date, this is recorded by debiting a company's expenses via the salaries expense account and also crediting a company's liabilities via the salaries payable account. However, when the company pays the employees, an adjusting entry is necessary. This entry debits a company's liabilities via the salaries payable account and credits a company's assets via the cash account, thus recording that the salaries expense has been paid.